During our recent dialogues with clients concerning China, a frequently posed question has been the potential parallel between China's current economic situation and Japan's balance sheet recession of the 1990s. The risks of the Japanification of the Chinese economy looms large, driven by the combination of factors including aging population, rising debt problem, and the recent downturn in the property market. Since the start of the year, news of the early loan repayments within the household sector has brought back memories of Japan's balance sheet recessions in the 1990s. Yet, the fears of China undergoing Japanification may be misplaced. The trend of early loan repayments represents a calculated adjustment by residents reflecting current economic conditions rather than a debt minimization strategy. Moreover, as the household sector cut back on the mortgage loans, there has been marked increase in the liquid assets. This trend may indicate a preference for the risk aversion rather than the balance sheet recession. We think there are three major distinctions separating China today from Japan in the 1990s. Firstly, on exchange rate, Japan's acceptance of the Plaza Accord in 1985 led to a sharp appreciation of the yen, which contributed to an asset bubble and later a severe contraction in the economy. Unlike Japan, China faces downward pressure of its currency. It's also worth noting that China's government has significant control over the exchange rate. The contrasting currency pressures and regulatory approach make a Japan-like scenario less likely in China. Secondly, there are differences in per capita wealth and middle-class proportions. With a per capita GDP of nearly $40,000 in the 1990s and a huge amount of the middle class, Japan's asset bubble bursting led to a widespread balance sheet recession. Instead, China's per capita GDP is only slightly above $12,000, and the proportion of the middle class is much lower. Not everyone has the balance sheet to shrink in the first place. Lastly, on the governance system, Japan had a smaller government. This led to less effective intervention to control the property and equity bubble. In contrast, China has a larger government and a larger market with significant influence over resource allocation. This includes strict limitations on banks, real estate investment, and the control over land, housing, property prices, and mortgages. Furthermore, Japan's closer political and military ties with the US influence its economic policy choices. In contrast, China's government enjoys greater autonomy in decision-making, arming it with tools to stave off potential crises. To conclude, while there may appear to be the surface-level parallels between China's current economic situation and Japan's recession in the 1990s, the inherent differences in areas such as exchange rates, wealth distribution, and governance structure set the two apart. The present liquidity challenges in the property sector don't change our long-term outlook for China.